In the wake of the COVID-19 pandemic, billions of dollars were made available in emergency loans to help businesses survive. These loans were intended to provide critical support for struggling companies during uncertain times. But for some, the crisis was not just an opportunity to survive. It became a chance to deceive, exploit, and steal. This is the story of Henley, a man who took advantage of these relief programs for his own criminal gain. In this video, we'll dive into how Henley manipulated COVID-19 relief programs. His deception began with fraudulent applications, but it quickly escalated as he created fake businesses, laundered money, and exploited the trust placed in these financial systems. The consequences of his actions were far-reaching, affecting the financial system and countless victims who lost out on vital resources. From fraudulent loan applications to fake businesses and money laundering schemes, Henley's story highlights how financial systems designed to help people can be weaponized by those willing to deceive the system. In this video, we'll break down the details of his deception and the devastating effects it had on both individuals and institutions alike. Before we dive deep in, let us first meet Henley and what the public know about. Henley was an entrepreneur, or at least, that's how he presented himself to the outside world. Prior to the pandemic, his business was small and struggling, operating in a highly competitive market. With little to no financial cushion, Henley was living paycheck to paycheck, trying to keep his head above water. His business had a handful of employees and didn't have the resources to weather any prolonged economic hardship. But when the COVID-19 pandemic hit, the global economy ground to a halt. Lockdowns were imposed, businesses shuttered, and the financial future became uncertain for millions. It was in this climate of chaos that Henley saw an opportunity, not just to survive, but to thrive at the expense of the very system set up to help struggling businesses. When the government rolled out emergency relief programs, Henley, like many others, saw it as a lifeline. But unlike the intended recipients, Henley saw it as a chance to exploit a broken system for personal gain. The rise of COVID loans. In response to the economic devastation caused by the pandemic, the U.S. government, along with other international bodies, launched several relief programs designed to prevent widespread economic collapse. Two of the most well-known were the Paycheck Protection Program, PPP, and the Economic Injury Disaster Loan, EIDL program. The goal was to provide businesses with the financial support they needed to keep workers employed and their operations running, ensuring that businesses didn't fail under the weight of the crisis. With billions of dollars on the table, the financial world saw an influx of loan applications. These programs were designed to help businesses stay afloat, but the sheer volume of applications created an environment ripe for exploitation. While many businesses struggled to prove their need for funds, others saw the disaster as a chance to make fraudulent claims. The government, in an effort to quickly disperse the relief, implemented a relatively streamlined application process. The system was designed to move fast and provide immediate assistance. However, this speed and lack of oversight opened the door for fraud. Unfortunately, Henley was among those who chose to take advantage of these programs, believing that the risk of getting caught was low. The opportunity for fraud. While the COVID loans were intended to keep legitimate businesses afloat, they became a target for fraudsters. The government's rush to approve loans meant that there was little time for thorough verification. Financial institutions and the Small Business Administration (SBA) lacked the resources to vet every applicant carefully, which allowed fraudsters like Henley to slip through the cracks. Henley, seeing an opportunity to exploit the system, began the process of creating fraudulent applications. He manipulated documents, fabricated financial records, and inflated his business's size and revenue. Henley knew exactly what to do to make his business appear as though it was in dire need of financial help. He claimed to have a substantial payroll, forged tax returns, and submitted inflated income reports, all while fabricating employee numbers. These false claims allowed him to apply for loans far greater than what his business could actually justify. Henley wasn't alone in this. As the loan applications poured in, many others took similar routes, falsifying details, creating shell companies, and inflating losses to qualify for funding they were never entitled to. But Henley's systematic approach to creating fake documents and his manipulation of the application process made him particularly successful in deceiving both the bank and the government. As Henley's applications were processed, the loans were quickly approved. With minimal oversight and a fast-track approval system, the funds began flowing into his accounts. Henley's initial success gave him confidence, and as the money came in, he continued to exploit the system, applying for more loans, further inflating the scale of his business and its needs. Now let's look at Henley's methods, how he exploited the system. Number 1, through fake business creation. Voiceover. Henley's first step in exploiting the COVID loan system was to create a fake business profile. He knew that in order to qualify for the loans, he needed to present his business as a legitimate entity facing financial distress. So he began by fabricating the very foundation of his business. Henley filed false tax documents, stating that his business had significant revenue and that it was in good standing with tax authorities. To make his business appear legitimate, he presented fabricated documents that showed fake income, exaggerated operating expenses, and false financial histories. He even created fake business addresses and websites to make his company appear real. Next, Henley went a step further and presented non-existent employees. To justify the amount of financial aid his business required, he listed workers who didn't actually exist, fabricating payroll records to inflate the number of employees and their earnings. This made it look like his business was fully staffed and operating at full capacity. By presenting these fake tax filings and fabricated payroll records, Henley was able to create a convincing story of a struggling business that needed assistance. This made his application look legitimate and ensured that he would be able to access the relief funds intended for real businesses in need. 2. Loan applications and deceptive tactics. With a fake business set up and fraudulent documents in hand, Henley was ready to apply for the loans. Using the fabricated records he created, Henley submitted multiple loan applications to the government-backed programs, claiming that his business was on the brink of collapse and in desperate need of financial assistance to survive the economic impact of COVID-19. Henley's applications were designed to exploit the gaps in the loan approval process. The application forms asked for business details such as revenue, employee counts, and financial statements. Henley used the false records he had created, inflating numbers and hiding key details. His applications were detailed and appeared professional, making them difficult for anyone to question. He also claimed that his business had been forced to shut down temporarily due to the pandemic, a claim that was impossible to verify without a deeper investigation into his company. By providing fake contracts, fake tax returns, and fabricated payroll data, Henley was able to hide the true state of his business. He continued to apply for loans with slightly different business profiles, leveraging the lack of oversight and the fast-tracked approval process during the pandemic. Henley's applications were accepted without much scrutiny. The relief programs designed to process loans quickly to prevent financial collapse didn't have the time or resources to thoroughly investigate each applicant. Henley was well aware of this and took advantage of the system's inefficiencies. Soon enough, Henley had access to millions of dollars in government-backed loans. His success in acquiring these loans wasn't the result of a lucky mistake. It was a direct outcome of his meticulous preparation and exploitation of weak points in the system. Number 3. Money laundering and the disappearance of funds. Once Henley received the funds, he knew that he had to act quickly to launder the money before it could be traced back to him. He began moving the loan money through various bank accounts, intentionally making it difficult to trace. He transferred the funds between different accounts, some in his name and others in the names of people he controlled, or even in the names of fake businesses that he had set up to act as a cover. Henley knew that simply withdrawing large sums of money would attract attention, so he used a variety of tactics to obscure the trail. First, he moved the funds through multiple accounts in both local and international banks. By doing this, he ensured that tracking the movement of funds became more difficult. The funds were split across various accounts, making it harder for investigators to follow the money's path. In addition to moving the funds, Henley began spending some of the money, He used the loan money to purchase luxury items, high-end cars, expensive jewelry, and real estate that could be resold if necessary. He used the funds to pay off personal debts and fund a lavish lifestyle, all while keeping the money well out of sight of authorities. Henley also went a step further and began funneling the stolen funds into international accounts. Using digital banking apps, he was able to transfer the money across borders, making it harder for regulators to trace the movement of the funds. These international transfers were made to accounts in countries with looser banking regulations, further complicating any potential investigation into his activities. Henley's ability to move and launder the money was made easier by the fact that many financial institutions had yet to fully implement the kind of advanced fraud detection systems needed to identify suspicious international transfers quickly. By the time investigators would have started looking into the transactions, Henley had already moved the money far beyond the reach of standard banking regulations. The funds, which were originally intended to support struggling businesses and keep employees on payroll, had now become part of Henley's fraudulent empire. He used the COVID loan system, designed to keep legitimate businesses afloat, as his personal tool for enrichment. Henley's operation was a well-orchestrated scheme that exploited the system's lack of checks and balances. He used a combination of forged documents, deception, and money laundering tactics to steal millions, all under the guise of a business desperately in need of help. What seemed like a legitimate business turning to the government for aid turned out to be a carefully crafted fraud, one that would ultimately come to light, but not before Henley had siphoned millions into his own pockets. Next, it's time we take a look at his discovery and investigation in Accuse. Despite Henley's best efforts to cover his tracks, there were red flags. No matter how well he thought he had hidden his fraudulent activities, the sheer volume of money he was moving and the discrepancies in his business records started to raise suspicions. The first signs of trouble came when Henley's transactions began to appear on the radar of financial institutions. His loan applications and the subsequent large wire transfers were not typical for the small business he claimed to operate. Institutions began to notice that the business activities he described didn't match his financial history. His rapid movement of funds, especially the large international transfers, did not align with the operations of a legitimate business struggling during the pandemic. The banks responsible for disbursing the loans began to flag some of Henley's accounts as suspicious, particularly after they noticed unusual patterns in the transactions. It wasn't just the amount of money, it was the speed with which it was moving and the lack of justification for these funds. It seemed strange that Henley's business, which was supposedly in dire financial straits, was suddenly flush with cash, enough to buy luxury items, pay off debts, and make large international transfers. Meanwhile, government watchdog agencies, including the Small Business Administration (SBA) and other regulatory bodies, were also conducting their own investigations into the COVID relief programs. They had received numerous reports of fraudulent claims and had begun reviewing suspicious applications and disbursements. Henley's case came to the attention of the authorities when auditors at the SBA noticed discrepancies in his paperwork. The financial data Henley had submitted in his loan applications did not align with the financial documents he had filed with the IRS. His claimed revenue, employee numbers, and other financial records were either overstated or entirely fabricated. The mismatch between his loan claims and the actual financial state of his business raised alarms. With this in mind, investigators began to piece together the puzzle. They started by looking at Henley's business activities and following the money trail, tracking the flow of funds into various bank accounts. They also interviewed people who were associated with the business. What they found was telling. There were no real employees, no physical office, and no legitimate business operations to back up the claims Henley had made. As the investigation into Henley progressed, financial analysts at these institutions used forensic accounting tools to analyze the fraudulent applications and financial movements. Using advanced tracking software, investigators were able to connect Henley's seemingly unrelated accounts and transactions. This was the beginning of the digital trail that would eventually lead to his downfall. The more investigators dug, the more inconsistencies they found. Henley had attempted to cover his tracks by moving the money around between different accounts, but his overconfidence led him to make mistakes. Some of the transfers he made were large enough to draw attention, and the audit teams were able to trace the funds through these accounts back to him. After the red flags were raised and the initial investigations began, the authorities closed in on Henley. A combination of whistleblower tips, financial data analysis, and government coordination led to his eventual capture. The funds that Henley had stolen were traced back to him through a combination of digital forensics and traditional investigative work. The breakthrough came when a whistleblower, someone who had worked with Henley's fake business, came forward with information. This whistleblower provided investigators with critical insights into Henley's methods, revealing the extent of his operation. They shared details about how Henley had created false payroll records, falsified financial reports, and applied for loans under false pretenses. This whistleblower's testimony gave investigators the crucial evidence they needed to move forward with a full-scale investigation. Once Henley's fraudulent activities were exposed, law enforcement launched a full-scale investigation. This included both state and federal agencies, as well as collaboration with financial institutions. The digital trail Henley had left behind was now visible to investigators, who had access to all his transactions, account histories, and loan applications. Law enforcement worked closely with forensic accountants who were able to track the movement of funds across various accounts, isolating Henley's activities and piecing together his criminal acts. As investigators connected the dots, they found that Henley had used the relief funds not only to enrich himself, but to hide his tracks. He had moved money through multiple accounts, purchased luxury goods, and transferred funds internationally. These international transfers, in particular, added a layer of complexity to the investigation, but investigators used advanced forensic tools to follow the money across borders and bring it back to Henley's accounts. In addition to the digital forensics, Henley's lifestyle began to draw attention. His sudden wealth, luxury purchases, and high-profile lifestyle became a point of interest for investigators. The authorities learned that Henley had used the loan money for everything from purchasing high-end cars to settling personal debts, far removed from what the funds were intended for, which was to support struggling businesses and employees. As law enforcement closed in on him, Henley's life began to unravel. His fraudulent business empire, built on lies and deception, was exposed. The real consequences of his actions were now clear. Not only had he taken millions in loans that were meant to support real businesses, but he had caused widespread harm by draining resources intended to keep people employed and businesses operating. What had started as a calculated scam now had a real-world impact on the financial system, leaving a trail of broken trust in the system meant to provide relief. As the investigation continued, Henley's every move was being tracked. The authorities had pieced together a comprehensive picture of his criminal activities. Investigators were able to confirm that Henley had manipulated the system at every step. He was arrested shortly thereafter, facing charges of fraud, money laundering, and conspiracy. The arrest was a culmination of months of work by law enforcement, auditors, and financial institutions working together to uncover the full extent of Henley's deception. The story of Henley's arrest garnered media attention, with headlines reporting how a fraudulent businessman had exploited the pandemic relief funds to line his pockets. While Henley's arrest was a victory for law enforcement, it was also a sobering reminder of how financial systems designed to help people in times of crisis could be manipulated by those willing to deceive the system. Next is the consequences and legal repercussions of Henley's crime. Henley's criminal enterprise, built on a web of deception, finally came to an end when law enforcement closed in on him. After months of investigation, piecing together fraudulent loan applications, money laundering activities, and the misuse of government funds, Henley was arrested. His arrest was the culmination of a complex investigation involving multiple government agencies, financial institutions, and law enforcement officers working together to track down one of the most audacious fraudsters of the COVID relief programs. Henley faced a series of serious charges, each carrying significant legal consequences. He was charged with multiple counts of fraud for falsifying documents, inflating his business's needs, and misleading the government and financial institutions. Additionally, Henley was charged with money laundering, as he had moved the funds through various accounts to conceal the illicit nature of his activities, ultimately using the money for personal gain. Perhaps most importantly, Henley was charged with conspiracy, as his fraudulent actions involved multiple parties, including the creation of fake businesses and manipulating financial systems. The charges against Henley were severe. If convicted, he faced significant prison time, with each count of fraud and money laundering carrying lengthy sentences. These charges were not just about the money he had stolen. They represented a profound breach of trust, as he had taken advantage of a crisis meant to help struggling businesses, diverting funds away from those who genuinely needed them. Henley's legal team worked tirelessly to prepare for his defense, but the evidence was overwhelming. The digital trail of his fraudulent activities, the whistleblower testimony, and the extensive analysis of his financial transactions left little room for doubt. The prosecutors were determined to make an example of Henley to show that those who exploited the relief programs would face swift and serious consequences. Henley's case became a symbol of the broader issue of COVID relief fraud. News outlets across the country reported on his arrest, detailing how his actions were part of a growing trend of financial fraudsters taking advantage of the pandemic relief efforts. As the case moved through the legal system, Henley's arrest sparked a wave of public outrage. People who had relied on government assistance to keep their businesses afloat were angry to see how Henley, who didn't need the money, had manipulated the system. The trust in these relief programs, which had been intended to save businesses and protect livelihoods, was shaken by his actions. Henley's crimes didn't just have personal consequences. His actions sent ripples through the entire financial system, affecting businesses, taxpayers, and the public perception of government relief programs. The most immediate consequence for Henley was the financial restitution he faced. The government sought to recover as much of the stolen funds as possible, but the reality was that a significant portion of the loan money had already been spent. Henley had used the funds to buy luxury items, settle personal debts, and even funnel money into overseas accounts. The chances of recovering the full amount were slim, and the financial damage had already been done. The legal repercussions were just as severe. In addition to the criminal charges, Henley was required to pay back the funds he had stolen, a sum that was calculated to be in the millions of dollars. The fines and restitution, combined with his prison sentence, were meant to send a message about the seriousness of financial fraud during a national crisis. On a larger scale, Henley's fraudulent activities severely undermined the effectiveness of the government's relief efforts. The COVID-19 relief programs were designed to help businesses that had been devastated by the pandemic, businesses that were struggling to pay rent, keep employees on the payroll, and survive the economic downturn. These programs were vital to the survival of many small businesses, but Henley's actions siphoned funds away from those who needed them most. The ripple effect of Henley's fraud was felt throughout the business community. Legitimate companies that applied for loans found themselves facing more scrutiny and delays as a result of the rampant fraud in the system. While most businesses had legitimate needs, Henley's case exposed vulnerabilities in the relief programs, leading to increased oversight, stricter regulations, and slower processing times. For the businesses that were harmed by Henley's actions, the consequences were equally profound. Some businesses that had been impacted by the pandemic found that the funds they desperately needed were unavailable because the relief programs were swamped with fraudulent applications. Others who had applied early in the process were forced to wait longer for approval, as investigations into fraudulent activities delayed the disbursement of funds. The public trust in financial systems, particularly government-backed loan programs, was eroded. Businesses that had been looking to these relief programs as a lifeline began to question whether they would ever receive the help they were promised. This caused frustration and anxiety for many who had been relying on these programs to keep their operations afloat. Moreover, Henley's fraud raised broader concerns about the efficacy of financial oversight. The pandemic relief programs were rolled out quickly in response to the economic crisis, but the lack of robust checks and balances allowed criminals like Henley to exploit the system. The scandal forced lawmakers and financial institutions to reconsider how they structure emergency relief and how they balance speed with thorough vetting of applicants. But the consequences didn't stop at the financial and legal realms. Henley's actions also sparked a national debate about accountability and oversight in government programs. Critics of the relief programs pointed to Henley's case as evidence that better safeguards were needed to prevent fraud in future emergencies. The lack of thorough vetting, combined with the rushed approval process, created the perfect environment for exploitation. This set the stage for significant reforms in how financial relief programs are managed, with a focus on ensuring that resources are directed to those who genuinely need them. For Henley, the impact of his actions would last a lifetime. His criminal enterprise not only cost him his freedom, but also his reputation. As the details of his fraud were exposed, his former associates and business partners distanced themselves from him. The public saw him as a symbol of greed and deception during a time of crisis, and his story became one of the most high-profile cases of COVID relief fraud. As Henley awaited his trial, the financial and legal consequences of his actions continued to unfold. Legal teams were working to secure his conviction, while financial experts worked to quantify the full scope of the damage he had caused. Henley would face the full force of the legal system, but the damage to the financial relief programs, to public trust, and to the businesses that relied on them would take longer to repair. It's time we examine the broader implications and lessons learned, the impact of Henley's actions on the financial system, and the importance of vigilance. 1. The vulnerabilities of financial relief programs. Henley's story highlights not just one man's greed, but the vulnerabilities in the financial relief programs that were designed to help millions of businesses survive the economic devastation caused by the COVID-19 pandemic. These relief programs were intended to provide critical support, keeping businesses afloat, employees paid, and economies functioning during an unprecedented global crisis. However, as Henley's case shows, these programs also expose significant gaps in the system, gaps that fraudsters could easily exploit. One of the biggest vulnerabilities was the speed with which these programs were rolled out. The government had to act quickly to provide financial relief, and in doing so, they streamlined the application processes to allow for rapid approval. But this speed came at a cost: insufficient checks and verification procedures. Financial institutions, overwhelmed by the volume of applications, simply didn't have the resources or time to thoroughly investigate every applicant. Henley took full advantage of this, submitting false information that went unchallenged until it was too late. The absence of a robust verification system, especially in the early days of the pandemic, allowed Henley and other fraudsters to fabricate business documents, inflate payroll numbers, and manipulate tax records. The lack of oversight meant that financial institutions didn't cross-check information with the IRS or other authorities. As a result, fraudulent applications slipped through the cracks, and billions of dollars intended for businesses in need were siphoned off by criminals. Additionally, the relief programs, especially the Paycheck Protection Program, PPP, and Economic Injury Disaster Loans, EIDL, were designed to be flexible. This flexibility was important because it allowed businesses of all sizes and industries to qualify for aid. However, the very flexibility that made these programs adaptable also made them vulnerable to manipulation. Henley, for example, was able to apply for loans under false pretenses, stating that his small business had employees and operating costs when in reality it had neither. These weaknesses, exposed by Henley's fraud, are not isolated. While he was one of the most high-profile fraudsters, countless other individuals and entities took advantage of the system in similar ways. The sheer scale of the fraud committed during the pandemic underscores the importance of reevaluating how emergency relief programs are managed and ensuring that future programs are better equipped to prevent similar frauds. Another vulnerability was the lack of real-time monitoring. Loan disbursement and approval were often too fast for adequate scrutiny. Financial institutions were focused on getting the funds to businesses quickly, and while this was essential during the pandemic, it made it easier for fraudsters to abuse the system. The delayed checks and balances created a situation where Henley and others could exploit the system for months without being caught. The vulnerabilities Henley exposed are not exclusive to COVID relief programs. This situation illustrates a larger issue with emergency financial aid systems globally. While these programs are designed to help in times of crisis, their design often prioritizes speed over security, leaving them open to exploitation. Henley's case should serve as a wake-up call for governments and financial institutions around the world to think more carefully about how they manage such programs in the future. 2. Lessons for the future. Moving forward, it is essential that governments and financial institutions implement stronger safeguards and more rigorous verification processes to prevent fraud from happening on such a massive scale again. Henley's ability to manipulate the system highlights the importance of careful and thorough scrutiny in financial relief programs, especially when they deal with large sums of money meant for vulnerable businesses. One of the first lessons learned from Henley's story is that verification needs to be more stringent. Governments and financial institutions must ensure that the documents submitted by loan applicants are thoroughly vetted. This means cross-referencing financial records with tax filings, verifying payroll numbers with the IRS, and confirming business operations with local authorities. Moving forward, stronger coordination between various agencies, such as the SBA, the IRS, and local chambers of commerce, will be essential to prevent fraudulent claims from slipping through the cracks. Additionally, governments should look to implement technology solutions to enhance fraud detection. The use of artificial intelligence, AI, and machine learning algorithms can help identify suspicious patterns in loan applications, flagging discrepancies and irregularities in real time. These technologies can be used to track the authenticity of business records, identify inconsistencies in financial documents, and analyze patterns of behavior to spot potential fraud before it happens. For instance, AI-driven fraud detection systems could be integrated into the application process, allowing these systems to flag potential red flags, such as overinflated business size or revenue claims. Machine learning algorithms could also analyze historical patterns to identify businesses that are most at risk for fraudulent claims. By incorporating such technology into the verification process, financial institutions and government agencies can catch fraudulent activity much earlier, reducing the likelihood of abuse. The importance of real-time monitoring also cannot be overstated. Governments and financial institutions must adopt continuous monitoring systems that can track loan distribution and the movement of funds in real time. If Henley's transactions had been monitored in real time, red flags would have appeared much earlier, alerting investigators to his fraudulent activity before he could transfer large sums of money out of the country. Another key lesson is the need for clearer and more precise eligibility criteria. While the government's goal was to make funds available quickly, vague or imprecise criteria for eligibility made it easier for fraudsters to manipulate the system. In future relief programs, clearer guidelines should be established detailing exactly what businesses are eligible for aid and providing businesses with more guidance on how to apply for funds honestly and correctly. As part of these reforms, governments should also prioritize transparency in the application process. For example, public access to a database of businesses receiving funds could increase accountability, allowing the public and media to track how money is being distributed. This level of transparency could help reduce the likelihood of fraud by making it more difficult for applicants to manipulate the system undetected. Henley's case also shows the importance of international cooperation when it comes to tracking fraudulent activity. Much of the money Henley funneled was moved through international accounts, taking advantage of regulatory gaps in other countries. Financial institutions across borders need to work together to track the movement of suspicious funds and ensure that these funds do not flow freely between countries with looser regulations. The development of international standards for monitoring fraud in financial aid systems could help prevent such abuses in the future. Finally, accountability must be at the core of any future financial relief programs. Governments and institutions need to ensure that individuals like Henley face the full legal consequences of their actions. Strong penalties for fraud, including hefty fines and prison time, will act as a deterrent for anyone considering abusing the system. Public awareness campaigns are also necessary to educate businesses and the general public about the severe consequences of committing financial fraud. If fraudsters like Henley are caught and convicted, it sends a powerful message that abusing relief funds is a crime that will not be tolerated. 3. Broader implications and reforms. Henley's story also serves as a cautionary tale, demonstrating how financial systems designed to provide relief can be easily manipulated if not carefully monitored. The COVID-19 relief programs, though necessary, exposed fundamental weaknesses in financial oversight. If we are to prevent similar frauds in the future, we must commit to improving the mechanisms of these programs, ensuring that they are both fast and secure. The COVID pandemic taught us many lessons about resilience, but it also showed how critical it is to safeguard the financial systems that help us in times of crisis. By learning from Henley's fraud and implementing these lessons, we can help ensure that future relief efforts are both effective and protected from those who seek to exploit them. Henley's story serves as a cautionary tale of how financial relief meant to help can be exploited for personal gain. It's up to all of us to ensure that systems of aid are protected from fraud. If you found this story insightful, like, share, and subscribe for more deep dives into financial crimes and fraud prevention.